What a messy market this is. Live from New York City this morning. Good morning, good morning. Your equity market down another 1%. Some negative follow through from a brutal session yesterday. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
Live from New York City, we begin with the big issue, the equity rout intensifying.
The market is, it's trying to find a bottom in here.
This has been a valuation re-rating.
We're starting to see inflationary pressures really affect the earnings of companies.
We have a proper kind of recessionary pricing coming through.
We're pricing in a near-death experience where everyone frets, worries very deeply.
Over the summer, the S&P could touch down to around about 3,600.
We're seeing a lot of headwinds.
Notably lower growth, and we're going to see frustratingly high inflation.
The market, as I see it, is divided into two camps.
It started out as an inflation scare.
One who believes inflation is out of control, Deutsche Bank and others.
Then it became a growth scare as well.
The second who are very worried about recession.
There's a lot of pieces moving around here.
We still have time in this bear market.
Joining us now to discuss, Principal Seema Shah, Richard Bernstein of RB Advisors. Seema, first to you. Just what are we pricing in here?
It's an interesting one. The way that the market is reacting is as if there's a recession coming. But then when you hear from analysts talking about potentially a Fed put coming, then surely that risk of recession is off the table. And we have a slightly different view to that.
What is your view on it?
Well, look, until yesterday, I think that our key view is that, look, we've actually had very, very weak markets. What we would have anticipated is a bit of a stabilization in the market because the economy is still relatively robust and you still have positive earnings growth. And then we would have said this is the time to go risk on, but at least be neutral. And then in preparation for losses, maybe into next year as recession fears really come to the forefront. But I have to say, yesterday really stopped us in the tracks with the news from Target and Walmart. I think we have to really take consideration of that, of potential weakness from consumers already starting to come through.
Richard, we've gone from seemingly an inflation shock to a rate shock and now a growth shock. Is that what this is?
I think to some extent you're absolutely right, and I think Seema's right about the growth side of things. But I think we have to remember that the number one issue here is a re-rating of the market, right? We effectively had a bubble in long duration assets. That bubble is now deflating. And on top of it, the Fed is now going next month to start extricating themselves from the long end of the market. So we had a bubble in long duration assets. That bubble is now deflating. What you're finding is short duration assets, things like energy, are actually up this month. So I don't think it's purely a growth scare, but certainly long duration assets are taking on the chin right now.
Richard, you've got a different view on the Fed as well. A lot of people would come on this show and they'd say, this Fed is so hawkish. And you say the following: you are what your Fed fund says you are. Can you build on that?
Right. So I find it actually quite curious that people think the Fed is so hawkish when the real Fed funds rate, the Fed funds rate less inflation, the real Fed funds rate is basically the most negative it has ever been in history, right? It's about -7, -7.5 right now, regardless of what measure of inflation you might use. And every recession in the last 50 years has been preceded by a positive real Fed funds rate. Now we have the most negative one in history. It's hard to argue that the Fed is even trying to slow the economy, let alone slow inflation. I mean, yeah, it's like shooting elephants with a pea shooter. They're hunting, but how effective are they going to be?
So, Richard, with that in mind, walk me through what you do expect. Hard landing, soft landing, something in between. Just listening to you there, a lot of people might assume that you think the Fed hasn't even started, it's got to go a whole lot further, and there's more pain ahead. Do you have a more nuanced view than that?
I think, Jonathan, the way I would describe it is I don't think a recession is imminent. I think that eventually we will have one because the Fed will panic at some point and they'll likely over-tighten. But the odds of that happening in the next several months or even this year seems low to me. And, Jonathan, if we're going to have a recession, this is going to be the most well-forecasted recession in my career. Usually recessions surprise people. They bite people in the tush.
Sure.
It's not like people are forecasting it.
Okay, I hear you. we've been talking about it all the time for the last 3 months. We've been talking about inflation for the last 12 months. And Seema, like Richard, I sat here and thought, OK, this is a well understood story. And like you, I saw those numbers from Target yesterday, a confused C-suite there at Walmart, a stock down by 25% on Target, a move we haven't seen since 1987. And Seema, I thought, OK, well, it might have been well understood, but how well priced was it? And clearly not very well priced at all.
Yeah, I would agree. And that seems like it's really been a feature of the market for so long. Just thinking about inflation, the market, the Fed, everyone believing it's transitory. And, clearly that has been proved completely wrong. And similarly with the Fed, I do wonder if the market has, it moved a little bit too high up. Maybe 3 or 4 weeks ago, and now with this idea about a Fed put there, once again, you're ignoring the inflation picture.
So, Seema, let's talk about downside. Barclays out this morning saying risk firmly tilted to the downside. HSBC out this morning saying the growth risk is here right now. It's not next year, it's right now. Deutsche Bank saying right now we're at the recession crossroads. This is what Binky Charter had to say for the near-term call. I'll get to the base case for the long-term later. The near-term, with the cycle late and the Fed's guidance to a rate hiking cycle that ended in recession 73% of the time, we look for the market to price in a full average recession decline of 24%. He's looking for 3650 on the S&P in the near term. Seema, your thoughts on that?
Yeah, so look, actually, we're not too different on that. So our baseline is recession late 2023, early 2024. And as soon as the market really starts sniffing that out and really puts to bed this idea that there's going to be a Fed put any time soon, then I think there could be further losses. There's always going to be opportunities within equities, but from the index level, I think that's possible.
Can't keep up with this market. About 24 minutes out, not hours, from the opening bell. We're down by about 1% on the S&P 500. On the Nasdaq, down 0.9%. Though, Kaylee, 24 minutes feels like 24 hours in this market sometimes.
Yeah, it absolutely does, because it's one of those markets, John, in which the price action has been absolutely brutal recently. Of course, yesterday, the worst day for the S&P 500 since June of 2020, but really just one in a series of big down days we have seen that have taken the index down about 18% from its record high in January. We're getting very close to a technical bear market. Right now, S&P futures are trading at 38.85. A bear market would be at 38.37. So we're within about 50 points. And when you look beneath the surface of the index, there actually are 4 sectors: financials, tech, communication services, and discretionary, that already are in bear markets, down more than 20% from their peaks, 33% in the case of discretionary, which feeds back into that Target story that you were mentioning. But all 11 sectors are off from their record highs. Even energy, which is where you have been able to get some gain in the equity market on a year-to-date basis, that was not immune from yesterday's selling, with only 8 stocks in the entire S&P 500 up on the day yesterday. That is how broad-based the selling was. As for the reason why, as you three have just been discussing, it's all about growth concerns now. The idea that central banks are hiking into weakness. Potentially there's a recession coming in the not so distant future. David Kostin over at Goldman Sachs doesn't think a recession is inevitable, but when he crunched the numbers, he came up with a similar story as Binky Charter. 3650 is where you would get if you saw the average 24% decline, as we've seen in the 12 recessions since World War II, or the median rather. The average brings you down about 30%. That could take us all the way down to 3360, John.
Katie, thank you. I see this right across the street right now on Wall Street, just pouring through all the research. There is this near-term call, super cautious, then this long-term call, we get better. We have this relief rally into year-end. You see with Deutsche Bank too, we've talked about that downside in the near term of 3650. Binky Charter over at Deutsche Bank still has a year-end price target of 4750. The median price target on Wall Street right now is 4800. I see it time and time again. In the near term, this is from Goldman. 3-month forecast, 4K. We expected gains likely coming later in the year, but ultimately in the near term, this is what they say. Higher equity prices in the near term would ease financial conditions. So ultimately, any easing of financial conditions would be seen by the Fed perhaps as an unwarranted loosening of financial conditions. HSBC, you'll see a similar theme here. Look at the cautiousness in the near term, and then look at this relief rally they look for in the long term. They said the following: the next couple of months, we'll see the growth shock dominating the real rate shock. We stay defensive with an underweight in equities and high yield credit. Their forecast for the S&P, 4450. The idea we get this relief rally into year end. Richard, I want to come to you on this. This near term call on Wall Street right now, that things are bad, it's going to be a rough summer, put together with this second half call that you get a relief rally and we end up somewhere close to 4800. Does that make sense to you?
Well, I think it's normal. I'm not sure it makes sense, using your term, Jonathan. I think, look, long-term sentiment is always kind of based on three different characteristics when you start getting a bear market. Number one, whether it's inflation or the market right now, the initial thing was it's temporary or transitory. Then you get people talking about it's peaking or it potentially is bottoming. You'll know it's over when people say it will never end. When people attach permanence to a bear market, when people attach permanence to bad economic data, that's when you should start, your contrarian antenna should start wiggling. Right now, I would say this is actually quite normal. I don't see it as being much of a signal other than that normal progression of sentiment.
Would you see it as a signal that perhaps we just haven't seen capitulation, Richard, or do you think the South side is completely divorced from what's happening on the buy side, what's happening in this market?
Oh, I don't think you've seen capitulation at all, Jonathan. I mean, how many times have we heard people looking for, quote, entry points back into technology? I don't think you've seen capitulation at all.
What do you think it looks like? How would you gauge it?
Well, if you just look at NASDAQ's retracement now, NASDAQ's down roughly 29-30% from its peak. I think if you look at 2000, I think NASDAQ went down about 75% from its peak or something like that. So, this would say we're in the midst of it. Granted, I'm using a sample size of 1. I understand that, but
you're also using the most extreme example too, Richard. But carry on.
Yeah, of course. But if that's your example, then you'd have to say we're in the midst of it. Right? We're in the middle.
Seema, what's your take on that?
So I don't want to use that example as it's a terrifying one. Look, I think the market has to come to terms with what's really coming. I don't think we've ever had as clear long-term vision as we have now. I think that there's a risk that some of that long-term vision of knowing that there's a really significant slowdown coming within the next 18 to 24 months can cloud some of that near-term view. But I think we also have to be respectful of the data that's coming in. Some of the earnings figures are concerning, and it's telling us that maybe the consumer is struggling a little bit more than we expected. And some of the equity markets, some of the various sectors are going to struggle even more. So I think we could see further losses coming. But I have to say that to the end of the year, I think we see more of a range bound. We're going to see a fair amount of volatility, but we're going to see equity markets moving up from good data, down in some pretty bad data. And then you get to the end of the year, and then I think that's when the pain really starts to begin.
Seema, just on the retailers and the numbers we saw recently, Target down 25% yesterday, Dollar Tree down 14.5%, Costco down 12.5%, Dollar General down by more than 11%. It's easy to run away with the bearish theme. I've got to ask a different question, just to kind of probe your thinking on this matter. I haven't heard the same thing from the airlines. If I listen to the airlines about the consumer right now, they tell me the consumer's strong, they're able to put up prices and pass on higher costs without much pushback. Seema, is this a change in the product mix? Is it a change in consumer behavior, or is it a real sign of consumer weakness?
No, so the interesting thing with the airlines, I think this is more of one of those post-pandemic themes where we are seeing that rush for airlines. We can see it just, talking to anyone on the street. Everyone is really wanting to go on holiday after the first time in 2 years or so. So I think that this is one of those short-term post-pandemic trends, and you get into 2023 and we see some normalization of that. And you see the economic growth behavior start to weigh on things like airlines. This is a good time for airlines, but that is a post-pandemic trend rather than a feature of economic strength.
Seema and Richard, sticking with us. We are about 17 minutes out from the opening bell. Equities do recover just a little bit. We're down 0.75% on the S&P. On the Nasdaq, we're down about 0.5%. Breaking down the movers, here's Abby.
Hey, John. Well, yes, futures are off the lows, but nonetheless, lots of laggards to taking a look at. Starting off with the shares of Cisco Systems, and networking giant, plunging. This, of course, after the company yesterday slashed its current quarter revenue view to a negative 1% to down 5.5% from up 6%. So again, slashing the revenue view on China COVID lockdowns and the Ukraine war. Encouragingly saying it doesn't have much to do with consumer demand, but nonetheless, not a great picture there. Kohl's down 6.1%, a very familiar story. Earnings, they missed by more than 80% on high costs, of course, lowering the outlook, and inventory up 40%. So the department store version of Target and Walmart hitting Kohl's. Under Armour down almost 5%. This, of course, after the CEO yesterday walked away from the job after 2 years. Shares in free fall this year, down 60%, basically from last year's peak. And then finally, breaking news moments ago, Harley-Davidson at session lows, pre-market lows down 9.9%. 0.9%. They are temporarily suspending shipments on a compliance concern. Taking a look at the company's statement, they are saying that out of an abundance of caution, based on information from a third-party supplier, they are suspending shipment of all vehicles for a 2-week period. Stock not liking it, John, down 9.9%.
Down close to 10%. Abby, thank you. Coming up on the program, passing the buck on record gas prices.
President Putin's actions are what is driving the price increase at the pump. The president is focused on doing everything in his power to address the Putin price hike.
That conversation up next.
The Federal Reserve is independent. We leave them to make their own policy decisions. We do not get involved in that, and nothing has changed on how we see the stock market. We do not. That's not something that we keep an eye on every day. So I'm not going to comment about that.
The White House shrugging off concerns about the equity route and placing blame on Russia when it comes to the pain at the pump.
The reason why we have that challenge is Putin's decision to invade Ukraine and the implications of taking Russian supply of crude oil and natural gas, but also of Russian refinery capacity off of the global market.
Here's a stat for you. Gasoline prices now topping $4 a gallon in every single U.S. state for the first time ever. AMH down in D.C. for more. Morning, Anne-Marie.
Good morning, John. Well, today, House Democrats are going to be going after corporations. They have a plan that they're forging ahead, which goes after corporations for, quote, price gouging. And when you look at some of the text, this would give a power to stop the sale of consumer fuels at excessively, or unconscionably is what they call it, unconscionably excessive prices. Now, this is really just a broader narrative from this administration and Democrats on the Hill going after corporations, not just in oil and gas companies, but meat packing companies, saying that they are going after and taking advantage of the pandemic era disruptions to lift consumer prices and make profits. Now, there is some polling out there that does show that consumers are annoyed with oil and gas companies who are raking in record profits. But when you talk to economists, especially those that even align themselves with the Democratic Party, they go back to something Secretary Janet Yellen said herself. Inflation is a matter of supply and demand, and many see little evidence that this is price gouging.
So, Anne-Marie, let's talk about refining capacity and the politics of that. It's easier to speak to the electorate sometime and just find the blame and just say it's price gouging. It's hard to convey the complexities and nuances of what happens further downstream with refining.
Yeah, so there's two big problems right now when you look at the global oil market and what that means when you break that down into products, jet fuel, diesel, and obviously gasoline or petrol, wherever you are in the world. So first is the fact that there needs to be more oil in the world. And part of this, as Brian Deese, you heard, is exacerbated by what's happening with Russia. You're taking out a massive producer of commodities, most notably oil and gas. Then you have the fact that this refining capacity is very low. And we have been coming into this season, which is peak driving season in the United States, the summer months, with inventories of these products very low. So you have low inventories, and then refining capacity, the ability to turn that crude into actual products, is very, very low. And Jonathan, this has been an issue before the pandemic. Refineries have been shutting down. There's not a lot of investment in it. And the bottom line is you cannot fix this overnight. Building a new refinery, putting investment in it, that takes months, if not years.
Yep. AMH down in D.C. Anne-Marie, thank you. Wealth destruction in the equity market, gas prices higher. It's a difficult moment to be in power, that's for sure. Difficult moment to be the consumer, even more so. Chris Harvey of Wells Fargo says this on the energy sector. The energy sector margins have improved sequentially in each of the past 5 quarters, while the overall market's margin trend has been flattish to down. That sector is up by more than 40% this year on the S&P. Seema Shah, it's a sector people still like. I want to understand, at some point, the cause of the pain, energy, becomes the victim of the solution. Energy gets hit by weaker demand. When does that happen?
Yeah, it's a really good point. And, you know, we, like most people, have really liked energy commodities within the real asset space as well. We have to start becoming a little bit more concerned that as we get that growth slowdown coming through, especially if you see the China slowdown really starting to gather pace, then I think that you could see that energy sector performance start to turn. I don't think we're there yet, As I said, I think that the payment starts at the end of this year, early 2023. So for now, I think we're okay, but it is definitely one to watch.
Richard, where are you taking risk right now? Where are you comfortable taking equity market risk?
Well, Jonathan, I'm going to take the opposite side of that on energy from what Seema just said. I think we think the energy sector is actually quite attractive. The energy sector right now is the #1 sector for dividend yield, higher than utilities, higher than REITs. It's the #1 sector for dividend yield. And here's the shocker, it is the #1 sector for 5-year projected earnings growth rate. So it's the #1 sector for yield, and it's the #1 sector for growth right now. In fact, that 5-year growth rate is almost double that of the tech sector. So growth investors just don't believe the numbers yet. They don't want to believe the numbers. But our attitude is take the data for what the data is. And why would we think that energy analysts are dumb and tech analysts are smart? But energy analysts have a tremendous 5-year forecast. So the energy sector, I think, is still a very attractive sector. The one thing that I don't think people are considering is, remember, China's been in a lockdown. Their energy demand has been muted. What's going to happen as they open up? Could we be looking at April, May, June, July of 2020 in China happening right now for them as they start opening up, which would increase demand, which would make prices go even higher. Final thing I just want to say, Jonathan, on this is I think the energy sector is the least understood sector in the entire marketplace. The notion that we are energy independent is completely wrong. And you mentioned this about refineries.
Yeah.
We can't refine our own shale oil here in the United States. That's all for export. But people don't realize that. So they think by drilling, we're going to solve the problem. It's refining that is the problem, not drilling. And as Seema pointed out, that takes years to build. It doesn't happen overnight.
Richard, if you want to make someone look like a fool, ask them to forecast the price of crude 12 months out. No one's good at that. Richard Bernstein, Seema Shah, to the both of you. Thank you. Futures down about 0.8% on the S&P 500, slightly negative as well on the Nasdaq. The rout continues. Up next, the morning calls and later Coles cutting its profit forecast as another retailer falls victim to surging prices. 4 minutes away from the opening bell, equities negative. Here are your morning calls. First up, Morgan Stanley downgrading Under Armour to equal weight, seeing too much uncertainty following a surprise departure from the C-suite. Stifel downgrading Target to hold, pointing to weaker gross margins and a softer US consumer. And finally, Wedbush cutting its Tesla price target to 1K, expecting China lockdowns to weigh up on upcoming deliveries. A lot of barns, stables and closed doors and runaway horses in some of those calls. Dan Ives of Wedbush coming up. "24 seconds away from the opening bow this morning. Good morning to you all. We are negative once again. You're used to hearing that. We're down 0.9% on the S&P 500. On the Nasdaq, we're down about 0.6%. The good news is that we are well off session lows. The bad news is that we have some real negative follow-through from yesterday. Let's see opening bow, switch on the board and get to the bond market. That negative correlation between equities and bonds, it sticks. Equities lower, bonds up, yields heading south, down 10 basis points to 278.12. Keep saying this, but worth bearing in mind, 2 Mondays ago, 320 on a 10-year. Right now, 278. Euro finding some strength against the dollar. The dollar showing a whole lot of weakness in G10 against the Japanese yen and the Swissy. Euro dollar positive 0.75%, 105.44. And an ECB, judging by the accounts, that's ready to go soon on interest rates. Looking at crude, we're down 1.9%, 107.52 on WTI. We're about 30 seconds into this. Let's get you some movers. Here's Abby.
John, yesterday's carnage in retail continues this morning, led by department stores. This is one of the department stores has reported Kohl's plunging. This after they reported an earnings miss of 84%, not surprisingly, on the familiar theme of rising costs. They also cut the outlook. They have 40% increase in inventory, so perhaps some discounting ahead. So this is the department store version of both Walmart and Target. Macy's down 1.9%. They report next Thursday, probably some expectation that that could happen. Harley-Davidson, of course, out with news this hour that they are suspending shipment of vehicles for 2 weeks, an abundance of caution after a third-party supplier warned of a regulatory compliance issue. That stock down nearly 11%. And there is Kohl's again, but BJ's is actually bucking the trend. That stock is up, John. One retailer that beat earnings and revenues. They seem to be bucking the rising cost trend as gasoline helped out.
They are hard to find. It's hard to find those companies that are executing right now, given how quickly this economy is moving. Gabby, thank you. We're about 2 minutes into this one. Your equity market is lower by 0.6%. Everything on my screen, every single sector industry group is negative. We've got consumer staples down a little more than 1%, down 1.2%. Industrials down 0.9. Energy down 0.8. Financials down by 0.75%, no doubt, not helped out by what's happening in the bond market. Big cap tech has been under pressure all year. Let's get to Ed Ludlow on the West Coast for more. Hey, Ed.
Yeah, good morning, John. We're down 0.3% on the Nasdaq 100, 0.2% down on Apple, slightly higher on Amazon after those two stocks in particular had declines of more than 5%. What we're seeing on your screen is mega cap adding to a 29% drop from the Nasdaq's peak back in November, and I'll remind you that that peak came 1.5 months before the S&P 500. In all the conversation I've been having of the last few days, we're trying to place this bear market and sell-off in the context of what's gone before, the dot-com bubble, the global financial crisis. The reality is, look at that bottom row, the current decline. We've shared almost $8 trillion of market cap. And if you think about the mega cap names we're talking about on a year-to-date basis, at least, your Apples, your Amazons, those that showed some resistance in the early parts of this sell-off because of their strong balance sheets and their ability to circumvent supply chain crunches, look at those year-to-date declines. And they account for almost $3 trillion of the sell-off that I was just talking for. The same story, rising bond yields, concerns about global growth. Difficulty here is, where does it end? And we're still modestly lower on the Nasdaq 100, up now 0.2% on Apple.
Ed, stay close. I'll catch you within about 10 minutes' time to talk about some other things. I want to talk about Tesla just briefly with you. The stock is down by only 0.5%, but big Tesla bull, Dan Ives of Wedbush. He's going to be with us in about 10 minutes. He's cut his price target to 1K from 1,400. Let's be clear, that's still bullish based on where we are at 705.
Yes.
He said this, Ed, the success of the China story on both the supply and demand side are the linchpins to our long-term bull thesis. That said, the reality is the current Shanghai lockdowns have been an epic disaster. You've been covering it. What are you hearing?
Yeah, I think when you strip out all the noise around Elon Musk and Tesla, you go to China. It's been the engine room of growth. It's been their blueprint for being able to scale production globally, because we're so impressed by what we've seen in Austin and Berlin, we forget the pace at which they built that Shanghai factory and how quickly they went to market. And we remember one other thing about China, John. There are many more players there, domestic brand names that Tesla competes against successfully. So now that we recognize the problems, we start to have concern, and that seems to be what Dan Ives is talking about here.
Ed, thank you, buddy. I'll catch up with you in about 10 minutes. Catching up with Dan as well. 4 minutes into this, we're just about unchanged on the Nasdaq. We're doing okay for now. No idea if any of this sticks. On the S&P 500, we're down about 0.4%. A real lack of confidence, conditioned by the price action recently. Target, a great example of that. Go through the retailers. It was Walmart, then it was Target, now it's Kohl's. All three of them cutting their profit forecasts as surging prices eat into margins. The CEO saying the following: sales considerably weakened in April as we encountered macro headwinds related to lapping last year's stimulus and an inflationary consumer environment. Kaylee's back with us for more. Hey, Kaylee.
Hey, John. Well, we've been talking about margins for so long now, and up until recently, they've held in. Companies were seeing such strong demand that they were able to pass on the higher input costs they were facing to the end consumer. But it feels like, at least in some sectors, that story is starting to change as consumers have to pay more for basic necessities like food and gas. That is hitting discretionary spending. What's interesting, though, is that while that should raise concerns about profits going forward, you're still seeing earning expectations climbing. That's the blue line here on this chart, and the white line, of course, the performance of the S&P 500. So yes, John, we've seen multiples come in, but that's because the numerator price is moving, not because of the denominator. And of course, indeed, stock prices have moved in dramatic fashion. We're down about 18% Year to date on the S&P 500, down about that much as well from its record high. We're within about 70 points or so of bear market territory, and most strategists didn't really see this one coming. Back in January, they expected the S&P would add about 5% this year to around about 5,000 actually. We're now dancing around 3,900, so a classic game of catch-up is happening once again. The latest to capitulate, at least in some sense, HSBC 4450, the new target, and Binky Chadha, the big bull over at Deutsche Bank, cuts his target down to 47.50. That is in his base case scenario in which there is no imminent recession. But he says if one does indeed occur, John, we could go down to 36.50.
Katie, thank you. Thank you very much. In fairness to Binky, I was reading that note yesterday evening, near term 36.50. And then he basically said it's all recession dependent from there. What happens? The downside, the upside, the base case. There's the base case year end right now. What do you do with it? I keep asking that question. What on earth do you do with a base case year-end price target on Wall Street, a median of 4,800, when you're seeing this mess unfold right before your eyes? That's the story in equity. I want to talk about credit too. High yield spreads are just starting to break out in a way that gets your attention. 472 basis points right now. We had an offering yesterday from a company that I know you all know, Carnival. Carnival offered $1 billion of refinancing. The pricing discussions were in a range of 1025 to 1050. Olivia Raymond here at Bloomberg reporting on this. If you go back 7 months, that same company offering that debt, they were managing to upside the offering and the yield was just 6%. That's a monster change. So let's talk about what's happening in corporate credit with Invesco's Matt Brill. Matt, I want to start in high yield and work our way up in quality to investment grade. What's the signal from that, Matt? Just the change in 6-7 months.
Hey, good morning, Jonathan. Yeah, what's telling you is that it's getting harder and harder to borrow money, but the markets are open, and that's the key. The fact that they got the deal done yesterday is a huge positive, in my opinion. Had they not, that would be the story. Yes, they paid up for it, 10.5% to 8 non-call 3. So after 3 years, if they're doing better, they can buy it back. They can call it back. So they're buying themselves insurance. It's a lot more expensive than it cost just 7 months ago, though.
And Matt, that's the big difference between now and December 2018. In December 2018, the market wasn't open for this. Is that why you think the Fed's not going to turn around and go the other way anytime soon?
Yeah, so things are functioning. The Fed's going to do 50 in June. They'll do another 50 in July, and then hopefully probably 25, the rest of the year after that. There's talk about whether there's a Fed put. There's not a Fed put coming anytime soon. But the Fed is looking at what our market is doing and trying to figure out, is it being rational? And it is. People are paying up to borrow right now. And as people that lend money, we're not enjoying this, but we're actually, for once, in the driver's seat. We're actually having pricing power. We're dictating terms of the deals. We're putting covenants in deals that weren't happening before. So the Fed is viewing that as rational, as healthy. The Fed's also going to see that the margins are going to be shrinking and that consumers are being rational as well. Consumers are not continuing to pay up for and up for things. So you're going to start to see inflation come off. At the same time, the Fed is going to back away a little bit. And it's not a Fed put. It's just the Fed seeing that things are calming down in terms of growth and inflation.
Matt, with that in mind, I just wonder how much upside you think there is on yields in some of these markets at the moment. We've seen this market, the credit market, adjust to higher interest rates. Certain parts of it have been battered. Only recently have we started to see credit spreads break out in a more material way. Matt, what do you make of that development and how far do you think that can go?
Yeah, just to put it in perspective, double B high yield really underperformed all year long versus triple C high yield. So everybody wanted to buy the dirtiest bonds because the economy was fine and it was an interest rate risk that you had to worry about, not credit risk. And that switched. So I think that has changed in the last 3 weeks. We've also seen correlation, as you stated a few minutes ago, negative correlation now, where we're getting flight to quality on days like today, where we're not losing money in bonds and stocks for once on the year. So that's kind of normal. We're getting back to those to normal bond markets. I look at overall valuations in high yield. They look pretty attractive to me, but I'd stay up in quality there. I look at investment grade. The one metric we're looking at is 3 to 5 year corporates. 3 to 5 year corporates versus S&P 500 dividend yield. You're now getting about 4.1% in 3 to 5 year corporates versus 1.5 to 1.6% in S&P 500 dividend yields. They were basically in line for the last 3 to 5 years. All of a sudden, you're picking 200, 250 basis points to buy bonds versus stocks. That's a pretty decent trade, in our opinion, that hadn't existed for a long time.
Matt, you offered two things there, a duration story and a quality story, a preference, a duration preference, a quality preference. What's your sector preference?
So the sectors, you got to stay away from consumer cyclicals right now. So first off, that's very difficult. Energy has always been the area that you've been the most nervous about. Actually looks pretty good. And then the cheapest area to me that's just being indiscriminately sold right now is financials. So we saw Citibank. They came with a 10-year bond just yesterday at around 195 basis points. Earlier in the year, that would have been a little bit over 100 basis points over Treasury. So you're getting near 5% to buy a company. And I'm not recommending Citi, but I'm just using it as a reference.
Sure.
You know, that Warren Buffett's issue is investing in these types of companies, and yet their bonds are getting crushed. So I think that's a great opportunity.
Matt, I'll keep you out of trouble. No single names, don't worry. Just a final one here. I'll mention a single name, Carnival. It was a head scratcher for some people. They came in and did the refinancing at the time they did it, at the yield they did it right now. My question to you is the maturity wall. Just a little bit more on supply if you can. Is there a maturity wall out there, Matt, and how far out is it? When do you really need to start to get concerned about these companies needing to come to market?
So I'm glad you asked that, because it actually makes me sleep better at night knowing there is no maturity wall. So I'll talk a little bit about investment grade specifically, though. There's 2% of the investment grade market that is coming due in 2022. There's 5% in 2023, and there's 5% in 2024. The profile is very similar in high yield. There's no maturity wall. Companies do not have to panic right now. If they can get access to the market, they should go ahead and increase their liquidity a little bit, continue to term out securities. But this is not 2008, 2009, and it's not the end of 2018, which certainly makes me feel a lot better.
Matt, there you go. Helping people sleep well at night. We appreciate it. Matt Brill, thank you, buddy. As always, equities are just about positive on the Nasdaq by 0.2%. 12 minutes in on the S&P, just about negative by 1/3%. Certainly better than where we were a couple of hours ago. Coming up, the pain in big cap tech stocks making its way to China.
Direct investment flows into China last year were super strong. This year, I suspect they're probably going to be somewhat weaker.
That story, and Dan Ives saying China lockdowns will weigh on Tesla's June deliveries. He cuts his price target. The big Tesla bull, still bullish, but less so. That's next. This is Bloomberg.
China still wants to encourage investment inflow. So I don't think we're going to see a big shift. I think China will try to keep open its ports and logistical mechanism. It's obviously struggled to do so during the COVID lockdowns. It's going to be a major challenge for the economy and to entice foreign businesses.
Tencent leading the sell-off in Chinese tech. The company warning that Beijing's crackdown will not end soon. On the West Coast, let's get to Ed Ludlow for more. Morning, Ed.
Yeah, good morning, John. We saw broad selling across Hong Kong and Chinese-listed technology stocks. You know, this is cause and effect. Weak corporate earnings with a backdrop of a gloomy macro picture. Alibaba and Tencent, the biggest drags on the Hang Seng index. Tencent executives are warning essentially that despite signals from policymakers that they will ease on their regulatory crackdown on the technology sector, it's just not going to happen right away. It's not going to happen anytime soon. You look at the revenue growth of this company, which they reported at the same time, it has disappeared, evaporated, vanished. That is a chart which will worry some people, especially the right-hand side of it, right, where we've very steadily decreased in the top-line growth we're seeing from this company. The backdrop, lockdowns in China, a disrupted supply chain. But this is a global story, because we're seeing the sell-off in Chinese and Hong Kong listed technology shares replicated in both Europe and the United States. And you asked, John, what is the common denominator? And everything that I'm reading says that China lockdowns and the supply chain is the common denominator here.
Ed Ludlow, thank you. Dan Ives of Wedbush is on board. He's cut his price target on Tesla from 1,400 to 1,000. Here's the quote. The reality is the current Shanghai lockdowns have been an epic disaster. We expect to see modest softness in deliveries this quarter with a slower growth trajectory in the key China region into the second half. Dan Ives joins us right now for more. Dan, let's start here. We only spoke a few days ago. What's changed?
I mean, look, our checks, over the last week, especially even over the last 48 hours, it's just not showing the improvement that we wanted to see, which essentially means in China, going to be a pretty big disappointment, not just on deliveries, but production. And the zero COVID issues, have really been a Category 5 storm for Tesla here. And look, we're not just going to cut the price target just to cut it. I mean, fundamentally, there's a change. I think it's a new reality for Tesla in China. And that's why we're cutting numbers and price target accordingly. Still bullish,
Well, still bullish,
clear.
Dan.
I mean,
so let me jump in on that. On
still
1,000, on 1,000, given we're at 695 right now, let's talk about reality. How divorced from reality is your price target at 1,000 from the stock right now at 695?
It's all how you view it. If you think that the zero COVID issues continue for year, 2 years, then obviously it's unrealistic. We believe this is going to be something that will start to navigate smoother waters as we get into the second half of the year. Production will ramp in Giga, Shanghai. You'll start to see deliveries start to significantly ramp second half of the year. And I think that starts to happen. Then the Tesla growth story, again, starts to take hold. But, this is rose-colored glasses right now. I mean, the June quarter, in our opinion, given what we see in China, I guess, it looks like an epic disaster coming out of China.
Dan, how would you know if you're wrong about the future, though? What would tell you? And what would tell you that would get you out in front of this in a way that you weren't this time around?
I mean, if we go into June, July, and we're in the same situation, it's start, go, supply chain issues, that lockdown continues, and ultimately you do not see the ramp, then all of a sudden you could look at deliveries for the year that could be off another 100, 200K, because China, as Ed talked about, I mean, it's 40% deliveries, and it's a big part of the production and the most profitable. And then, of course, the sideshow, the circus show with Musk and Twitter. Yeah, it's been a black eye for Musk, and just I think the way that this has been handled has really been unconscionable in my opinion.
Dan, you called it a circus. Let's talk about this tweet. It came out yesterday from Elon Musk. I want your interpretation of it. In the past, I voted Democrat because they were mostly the kindness party, but they have become the party of division and hate, so I can no longer support them and will vote Republican. Now watch their dirty tricks campaign against me unfold. Dan, you're an analyst. I'm just a guy hosting a market show. We don't have to talk about the politics of this because I've got no idea what that means. But Dan, I do want to talk about the regulatory threat that this individual might face. How big do you think it is?
Look, I mean, it goes back to the Twitter situation in the beginning. It's been a disaster from the beginning, and he just continues to add fuel to the fire. And right now, at least from Tesla's shareholders, it's like, as the plane's crashing, you're worried about salted or unsalted peanuts. And I think that's the frustration, because you right now want Musk dialed into the Tesla ecosystem, navigating what we see in China as well as overall production issues. These sideshows, look, I think from an investor perspective in a white knuckle market, it's exactly what you don't want to see. It just adds more news, and like you said, even political blowback in what's just been, I think almost a tornado-like situation.
Dan, just a final question, and work with me on this. Often I'll speak to people on the buy side that become married to a stock. They're conditioned by it because it's treated them well over a series of years. They get the gains, and then they start to get punished by it, and things start to go wrong, and they just don't know how to get out of that name, and the losses build up. They become married to it. Dan, as an analyst, is there a risk that people who have been bullish this name for so long just become married to it? And how do you make sure that you don't become one of those guys?
Yeah, look, I think sometimes, to your point, there becomes an emotional attachment, whether it's bullish or bearish, right, on both sides. And that's why I think you can't wear the rose-colored glasses. You got to ultimately call, I guess, it comes down to fundamentals. And that's why China's story continues. Tesla is a stock, given electric vehicles, massive transformation. I think the stock will continue to move much higher. However, if all of a sudden it starts to falter, you cannot just expect that the past is ultimately a prediction of the future. And no doubt, I think that's right now, it's a fork in the road situation. As we go into the Tesla story, especially given Musk, I think right now there's been some almost semi-permanent taints on the story because of the way that this soap opera / circus show has turned out.
Dan, we'll keep talking about it. The stock, the company, the leadership, and as you say, the circus show. Dan Ives there on Tesla right now, 698. He's cut his price target from 1,400 to 1,000. 698 and down about 1.8% on the session. Up next on the program from New York City, your trading diary for our audience worldwide. Your equity market certainly not as bad as it was a few hours ago. And then we turn lower again. On the S&P, we're down by more than 1%. On the Nasdaq, we're down by 0.8%. This is Bloomberg. About 30 minutes ago on this program, I said if you want to make a fool out of someone, ask them to predict the crude price 12 months out. Another way of doing that is asking someone to predict this equity market 5 minutes out. We are all over the place. We were briefly positive on the Nasdaq, now negative about 0.5%. On the S&P, we're down 0.9%. That's the price action. Here's the trading diary. President Biden speaking at 10:30 Eastern. The president then heading to Asia for the weekend. Look out for some headlines from that. Retail earnings continue with Ross Stores after the close. Plus, Minneapolis Fed President Neil Kashkari speaking at 4 p.m. Eastern time. The Fed speak continues with Bostic and Esther George. Plus, the FOMC minutes coming up next Wednesday. From New York City for our audience worldwide, this was the countdown to the open. This is Bloomberg.